The price of bullion has pulled back from the highs of this year, as at the 15th of December. There's been a greater drawback in gold than there has in silver, but the rise seen earlier in 2016 has certainly faded across the asset class. But what about 2017? Well, Adrian Ash is head of research at BullionVault.com, and he joins us now with some more. Adrian, good to talk to you.
Hi, Jeremy.
Before we get into the gold price chart, what's 2016 been like as a year for BullionVault?
Well, I mean, it has, to use the cliche, it's been a game of two halves. The first half of the year we came into 2016, gold was on the floor. Gold was as hated as I've known it in 15 years in the market. And really, it looked like a very contrarian play. Suddenly, risk starts to raise its head for investors across the board. Obviously, Brexit, as that became, as the vote became a reality, and then we neared June. But also other broader political and financial risks started to come back. And gold rose 30%. To its July high immediately after Brexit. In sterling terms, Brexit, the day of the result, gold put on 20% against the pound. So the move has been very, very strong in the first half of the year and has really helped balance losses in other parts of portfolios for investors in the West. Second half of the year, I think there's been a lot of disappointment then with the way gold prices moved over the summer in particular. And really the kicker has been gold had become a consensus trade on a Trump victory going into the November US election. Having been the contrarian play at the start of the year, 2016 being a year of shocks, Brexit, Trump, Leicester City. You've now suddenly got everyone going, okay, well, gold's going to go up when Trump wins. He wins, gold goes up for about 12 hours. And again, that disappointment comes straight back in, and you're now seeing funds liquidating the positions, the insurance positions they'd built earlier in the year in gold. And when Western investors, particularly money managers, when they liquidate gold, the price goes down.
What effect has rising bond yields then had on? Because this is one of the big stories, I think, that's come out of the markets in the back half of 2016. Is there a direct link between that and the gold price?
Absolutely, because gold doesn't pay you, gold pays you no income, gold pays you no dividend. But as a form of savings, as an investment asset, it has those key attributes, those rare attributes of its physicality, its rarity, its deeply liquid market. It can't be destroyed. I mean, unlike bonds or currency, it can't be cancelled by a government. So that's its appeal, really, and that's its use. That's where it gets its use as a portfolio tool. The rising bond yields, which turned higher from the July lows, I mean, new record lows in bond yields across the world. And the rise since then basically means that it's getting more expensive for hedge funds to roll positions forward in gold. That's a direct mechanical impact on betting on the price going higher. Also, of course, it now means that bonds are a better bet, other things being equal. Of course, alongside that, you've also got a much stronger dollar. I mean, the dollar bull starting in 2011, 2012 has continued and only got stronger this year, even with the Trump victory now. And of course, US equities are hitting all-time highs. So you've got a triple whammy for the gold price in the back half of this year.
What about money controls as well in India? I'm hearing as well that has had an impact, a negative impact on the price of bullion.
Well, the issue really with Indian and also Chinese demand is household demand in those two countries equates to about 1 ounce in every 2 sold to end users annually. So they really are where bullion goes in the end. But they don't move the price higher. Those households tend to buy when prices drop. It's a consumer good, and people are buying it for very much as a long-term savings vehicle, so they'd rather buy on a dip. They're much more wily, perhaps, than Western fund managers. The issue now is the demonetisation of India's largest banknotes. The 500 and the 1,000 rupee note has caused, a cash crunch across the country. Ratings agencies are knocking 2% off GDP forecasts for next year. Whole industries have ground to a halt because there's simply no cash. 86% of cash in circulation was cancelled. That has hit the gold sector particularly badly because it's very much a cash transaction business. The government has done this ostensibly to try and crack down on, obviously, corruption is endemic in India as it is in a lot of third world countries, a lot of emerging markets. And they're trying to squeeze that black market money out. Well, if cash is the kind of lifeblood of corruption, of bungs and backhanders, gold is seen as a kind of fat store by the Indian authorities, a way of people parking undeclared cash, illegal money, and so on. So it is, but it's hitting the industry very, very hard. And what that means for prices right now, global prices, is it's difficult to know. Normally you get a response from Asian consumers who come in. We saw this in 2013 as a classic example. The gold price dumped 25% because of Western fund managers quitting ETFs, closing out their COMEX longs and going short. And then what you had was Asian households coming in and buying and eventually putting a floor under the price at 1180. Similar thing happened tail end of last year at 10.45. Now, is that mechanism broken? It's difficult to know. There's an awful lot of smuggled metal going into India still. We know that for all the government's efforts over the last 3 years to try and restrict imports, black market gold still goes in. China is an interesting case. China is the world's #1 gold miner, the #1 importer, the #1 consumer now, overtook India. And Beijing has been very pro-gold, very friendly to gold over the last few years as a way of diversifying people's savings and kind of national wealth in what is a communist state. They have started to restrict import licenses. Now, we're coming into a critical period for global gold demand, which is the Chinese New Year, coming at the tail end of January next year. You've then got the Indian budget. So you've at the moment got these two government interventions in the two largest gold consumers. And as I say, that does raise a question mark over the typical price mechanism, the response that we see from Asian households that would otherwise be expected to put a floor somewhere under the price.
Yeah. So despite all the headwinds, it's interesting actually, the price of gold still hasn't even got down to the point it was at in the 16th of December last year, which of course is when the Fed started raising interest rates. Knowing now what we know about 2016 and what you've spoken about at the beginning of 2017 with Adrian and so forth, how do you feel about 2017 as a company going into that market, which is what you have a large interest in?
Well, I mean, as a business, BullionVault has had a fantastic 2016. November was our strongest net gold demand. Clients adding gold in Singapore, Zurich, London, Toronto, New York, to their holdings vaulted there. It's the strongest month since November 2011. Almost best part of a ton went in. So clients have now got 37 tons of gold. It's more than most central banks hold. So in terms of private investment demand for physical bullion at cash prices, that is only stronger on this price drop. I think that's because people are taking a long-term view there. They can trade on BullionVault very easily at cash prices, but this is not a speculative market in so much. This isn't, you can't go short. This is about people building a long-term position. I think when you look at the risks ahead in 2017, we still don't know what Trump actually is going to do. We have no idea what Brexit actually means. I mean, just today we heard it could take 10 years, according to the UK ambassador to the EU. This kind of uncertainty really only fuels the kind of
German,
appeal.
French
we have German and French elections, exactly
Dutch
right.
Elections.
Dutch elections. So we have an awful lot of stress points, investment stress points, I think. Similar to 2016 then, I actually think the critical thing here is, you rightly say, we're not back at the price that we were last year when the Fed began to raise. Can we really call this a rate hiking cycle? The Fed went into 2015 saying it would raise 4 times, raised in December. Came into 2016 saying it would raise 4 times, raising in December. Now, this is like no rate hiking cycle in history, okay? And if we do see a Fed that continues to raise 25 bips in December, but the gold price is $100 higher, well, that, it's interesting. The Fed raised, gold hit a new floor last year. The Fed has raised again, really just kind of consolidating a lot of the background that we're seeing. Particularly look at equities. Do you expect the S&P to continue making new all-time highs going into 2017? Bond yields. Is the bond bull really broken? Because bond yields do matter to gold. Particularly what matters to gold, though, is real yields. When you look at the rate of return which bonds are offering, minus the rate of inflation. Now, we've had something of an inflation scare as a result of Trump. Personally, I don't buy it. I don't see inflation coming through. I mean, even in the UK, we've had this huge devaluation in sterling. Inflation got to what, 1.2%, 1.5%? I mean, it's not there at the moment. So in terms of real yields, that's what counts, and that's the thing to think about if you're looking at a position on gold in 2017. Yeah.
Interesting story. Adrian, thanks indeed for joining us. Adrian Ash is Head of Research at BullionVault.com, looking into what potentially could be a very interesting 2017.